Good evening. This is Ken Long from Tortoise Capital Management with the review of the weekend reports for August 25th, 2012. We're in a market that is bullish, quiet, on an annual basis using weekly RSI 14. It's neutral for 63 out of 100. On a 10-day NDX basis, it's right at the midpoint at 48 out of 100. Percent stretch above the 200-day moving average is 6.5%. That's white bullish. Slope of the 50-day moving average is still green bullish at 0.67, although it's given back a little bit. ADX has improved to above 20. It's still at the high end of neutral as far as trendiness. The bulls are in charge, however. ATR percentage is at a very quiet 0.73%. No change to the blended monthly rebalancing in either the 26 or the 13 ETF portfolio, with the next reevaluation on or about 1 September. In ETF 2, the theoretical exposure and the model portfolio are both at 100% exposed. Looking at the 13 ETF portfolio, everything is on a buy. Even treasuries turn positive again. And it's Australia, Asia less Japan, and U.S. technology at the top. That's the return of the risk on trade, plus I believe strength in commodities. We saw the stealth trade in silver and gold take off this week that we've been stalking, and so I think that's part of the return to commodities happening here. May have something to do with the promised QE3 as well. Lagging are Latin America, Japan, and even U.S. mid-caps have now moved down to the bottom of the stack. In the 26, it remains the same basic themes. Australia, Asia less Japan. Now we've added agriculture and emerging market bonds, Qs, emerging Europe, U.S. real estate. Looking at the health check, vertical blue lines are 10, 20, and 30 days of look-back period. The horizontal purple line is the 4-year high at 143. Actually, the 1-year high at 143, excuse me. We broke above that key mark of 142, but it resisted and has fallen back into the river. So 143 is the new mark on the wall for no resistance overhead. It was one peak above and then failed. The horizontal red lines represent support levels that have held in the past. The solid red line and then the red area is the 200-day moving average. The blue region, the river, is the 30-period Bollinger Band plus or minus 1 standard deviation. The thick green line is the 10-day moving average. Thin red line is the 50-day moving average. Everything pointed up. Right now we have a slight pullback here from that swing high at 143. A strong day up on Friday leaves price right even with the 10-day moving average right at on the upper Bollinger Band edge. This still looks to me like the yellow zone between 140 and 143. If this is truly just a pullback, as it would indicate by Friday's rebound, some follow-through should take it through 143 on the next surge. If it doesn't get through 143, then it looks more like plateauing in this region. The shaded pink and then the darker shaded pink are 5 and 10% pullbacks from the swing high at 143. That's what a 5% pullback between 0 and 5% would be considered noise. Between 5 and 10 would be a correction in a bull. And you can see we got just about 7% from price to the 200-day moving average. PPO has closed its jaws and is now pointing downward, which would suggest a pullback to about the 50 or the bottom end of the regression channel. The thick black line in the middle is a regression channel. It's been pretty descriptive of the price action here lately. And the outer black lines represent the channel formed by the maximum excursion from that regression line during the look-back period. So we would think of about 139, 138-ish acting as support. And we've got room in either direction for 2 or 3 points. Price above 143 I'd interpret as bullish and a continuation of this rebound ever since we were back at 128. Violation below, I would say, about 136, which is the southern part of the river, the 50-day moving average, the end of the 5% pullback. That's really 136 is solid support right here. I would see that a violation of that price level is the first indication that we're going to go back and check the 200-day moving average. So that's the healthy. Just looks like mostly a buy on dip opportunity to me. However, failure below 140 and I'll be short, because that would negate this big white candle. Take a look at the ETF2 regional report. Everything's on a buy. Everything's above the 4-month moving average filter. Technology is the strength. Asia less Japan is coming on strong. You can see starting to weaken now in the U.S. mid caps. The global is still, or S&P is still better than the global at 52, is better than 45. But overseas is starting to close the gap because they're both tied on a strength basis, 49 and 49. So you're starting to see some of this confidence from the U.S. starting to bleed over into the globals, as it looks like Europe is trying to get their act together. World market model is telling the same story. You're seeing Europe has come out of the hole, except for Austria. Even Sweden looking very strong. Australia, Singapore now with most of the Asian countries above average. Mids and smalls in the U.S. have given up their gains. This is an Apple effect, I believe, in the large caps and especially the tech. See some strength now in the commodity areas that have come out of red and into the yellow. U.S. real estate remains strong. And weakness now in what were the defensive plays, healthcare, utilities, and staples, are now pulled back to average. And you're seeing technology, and again, that's the Apple effect, improving, and then finance and energy improving. That's a part of the risk-on trade scenario. The top 30 ETFs out of the ETF2 database for your reference: home construction, biotech, mortgages, mortgage REITs, sovereign debt, biotech, telecom, real estate, the same usual leaders. Among the Dow 30, and now sorted by their relative strength, it's still the XLPs of the world: Home Depot, Merck, AT&T, Walmart, Disney. The producers are still suffering: Hewlett Packard, Caterpillar, Alcoa, McDonald's. Can't get out of the hole. And from a liquidity basis, you'll notice how weak the VIX has become, down to 4.23% on ATR percentage. It's basically cut in half. Okay, we're going to shift now to the daily report. Okay, back to the daily now. Let's take a look at the gap stat over the last 30 days. 16 times, 4 and 12. The market has gapped down 12 of those times. The gap down has reversed to close higher for an average follow-through of 0.33. Only 4 out of 16 times has the gap down continued to fail. So that's still the morning hook play is still in effect. No signals in overreaction or channeling. You can see how much volatility has come out of this market. ADX has now improved to above 20 with bulls in charge. This is a pullback opportunity. Friday was the first day of that rebound move. A handful of channeling and overreaction signals in the ETFs. Johnson & Johnson and Coke in the large caps. 5 days down for Intel. Lots of 551Ws based on the strength of Friday's move. It's a classic buy on dip opportunity, second day follow through. lots of things test out favorably, better than 2 to 1 on the retest of a 10-day high. So that should be those should be the candidates that you're looking at right there. You can see Hewlett-Packard testing out at 7.3 to 1. It's also max pain range compression. If you were looking at 551Ws, Caterpillar would be interesting. It's a 3.0 on a reward to risk. It's a 551W as well. IBM is a 551W and tests out at 2 to 1. Those would be high priorities in my view as well. I'll be looking at Alcoa as number 3, max pain range compression, and the fact that it had a doji on Friday. Hewlett-Packard and Intel look pretty interesting, also because of their week close with an RSI2 score of under 5. Caterpillar, RSI2 of 7, so that looks attractive as well. Among the ETFs, 2 test out better than 2 to 1 on the auto framer. That's utilities and coal. A large number of 551W patterns and some channeling and overreaction, especially in utilities. Utilities, it looks like an interesting swing trade here. If we get any more weakness in the market, that defensive play will become more interesting. Regression channel, the 30-day regression line. You see the pullback opportunity followed by a big day up. That's a classic 5 weeks up, 5 days down compared to the 5-day high, and then one big move up. So buying a breakout of that white candle is indicated as a resumption of the trend. This 3-day pullback right here, though, you can see has caused the regression line to come back to its 10-period moving average at an area just at about 1 standard deviation up. And so we really want to be alert that a failure to follow through here now threatens to come back to 137 and then even 135. So that signals a potential turning point. If we saw a pullback here, the same way we saw about 10 days ago, then that could be a 5% pullback to the 133 level. Looking at the z-scores of the regression lines, we have the 30-period beginning to stall at a logical place just at the upper level of normal. It's still as steep as it's been, except for this last period here about 4 months ago, and it's made a heck of a rebound here. Coming out of this hole where it tested the 200-day moving average, made a nice leg up. That's a really strong move. Made a new high, so a pause here would not be a surprise. It's pulled back to the edge of the river. The 90-period regression line, though, is pointing solidly up, and you see the 10 is pulled back, creating the opportunity to buy on a dip. So this is really a perfect buy on dip opportunity in a strengthening trend. You saw this last little move didn't have anything like the volatility of the previous move out, so a pause here and go should be rewarded instantly. Once it gets above 143, the S&P is free and clear to 150, which is a 5% move up. The Bollinger Band channel width is still on the narrow side of the last, compared to historical numbers of the last 10 years. So the squeeze is still kind of on, still is favorable for range expansion and volatility to the upside. Looking at the regression lines in the Bollinger Band River, still very favorable for the S&P, although the regression line crossover occurred here. The target on the downside is back to the Bollinger Band mean, which would be 138, and that would still be strong support. It's not till you get below 135 that this move up, this last leg up, is truly finally negated. IWM is just now starting to leave the river with the 30-period regression line. You can see the gold stealth trade has moved. The triangle right here was resolved to the upside, and that's, I think, hedgers acknowledging their potential of QE3. Treasuries looks like a buy on dip opportunity. It's already brought back 3% after this move, formed the regression line crossover. The river puts a price target about 127, and then 130 is the far side of the river. And so if we see this actually turning to fail in S&P, Treasuries are ideally priced for buy on dip. Frog stats just for reference. Brazil looks really interesting to me. It's number 4 on the blended strength because it has a very high fraud quality number, and yet its intraday percentage moves of 1.85% really give you room to go on big strong days up. So that's why it would be a favorite. Followed by oil is also very high frog. Hewlett Packard looks very interesting to me too at 3.3 frog quality with only a 15-cent initial stop and a 2.9% intraday range percentage. So that looks like an ideal trading candidate to me, Hewlett Packard. Fail stats, again, you should know these stats on your favored stocks. So you'd see how far it normally will pull back on those morning hook opportunities, which has been the dominant theme of the last 30 days, is the power of the morning hook. So on Hewlett Packard, as a way just to illustrate this, its average fail has been 27 cents. So not quite 2 frog standard deviations. So if I saw it move 20 to 30 cents, find support and start moving up while the rest of the market's moving up, I'd be pouncing on Hewlett Packard. Signal to noise ratio, these are symbols that have fat real bodies. You'll see some favored trading targets in there, the VIX. Anything above average still looks very tradable. Alcoa, technology, Latin America, Disney, small caps, all of those have relatively fat bodies. Looking at the holding X-day periods, we'll start with the 10. All the Z-scores are near 0, so there's this little pullback has given the market room to pause, refresh, and resume. So that looks favorable. The 40-day is mostly under 0, as is the 20-day. So this market has not run away from you. This is truly a buy on dip opportunity with a chance to go higher, up to test 150. It's got to get through 143, but if it does, then 150 is the next stop. All right, that's everything I want to cover on the review of the trading plan. So keep your powder dry and your risk measured. Thanks.